Financial Instruments video series. In this video lecture, we're going to be focusing on IAS32, which deals with classification of financial instruments. Please make sure to refer to the scope document of my CAA that shows the principles and concepts that are at awareness level, which therefore means you just need to have a general appreciation of those concepts and principles, as well as the concepts that have been excluded. Of note is the exclusion of hedge accounting. Okay, so after you've looked at this document, I'd like to also refer you to the IAS32 and IFRS 9 scope document, and this is found in para 32, para 4 of IAS32, and para 2.1 of IFRS 9. Please note that the following are excluded and will be dealt with in terms of the specific standards they're covered in. So your interest in subsidiaries, which are covered under your IFRS 3 and 10, as well as your associates or joint ventures, which are covered in IAS 28 and IFRS 11. Employers' rights and obligations under employee benefits will be dealt with under IAS 19, as well as contracts within the scope of IFRS 17 should be dealt with in terms of IFRS 17, which deals with insurance contracts. Financial instruments, contracts and obligations under share-based payment transactions will be dealt with under IFRS 2, and rights and obligations under leases will also be dealt with under IFRS 16. Note that the standard shall be applied to contracts to buy or sell a non-financial asset that can be settled net in cash or another financial instrument, or by exchanging financial instruments. So, for example, so what you need to know is what is a non-financial item. So examples of non-financial items would be your PPE, your inventory, right? And so you probably have a contract to buy or sell inventory or PPE at a future date, but then the settlement will be in cash or another financial instrument. So you're holding this contract not to actually buy or sell the specific non-financial item, but to actually realize a gain in the form of cash or another financial instrument, or by exchanging financial instruments. So please take note of this scope when trying to determine what transactions should be dealt with under IAS 32 and IFRS 9. Okay, so the objectives of this lecture are to identify a financial instrument as well as classify a financial instrument. So in this video lecture, we're going to be focusing on these two. In the coming video lectures, we're going to look at recognition and measurement of classes of financial instruments, as well as presentation and the financial statements. So let's get right into it. So what is a financial instrument? It is a contract that gives rise to a financial asset of one entity and a financial liability or equity of another entity. So what is important to note is that you need to have a contract. What differentiates financial instruments from other general assets and liability is the existence of that contract. So while you don't have a contract to recognize PPE or a website as your asset, you do have to enter into some type of contract to recognize the financial instrument. Okay, so we have identified what a financial instrument is. So it has to be a contract with two parties that are either holding a financial asset, a financial liability, or equity. So let's get into breaking down what a financial asset is. So a financial asset is any asset that is cash. So when we're saying cash, we're referring to any cash you might have on hand, any cash you have in your bank accounts, or any cash equivalents. So make sure that you do not limit to cash to any hard cash that you're holding. You could also have an equity instrument of another entity. Please take note of another entity in this case. So, for example, you have shares in Cassava. Cassava shares are a financial asset to your entity and an equity instrument of Cassava. So in that case, you actually have an equity instrument of another entity. So the Cassava shares would qualify as a financial asset. Then there's also financial assets are also a contractual right to receive cash or another financial asset from another entity. So if you so an example would be your trade receivables, any loans that you've issued, or any bonds that you have actually purchased. So you actually have a right to receive cash in that instance, right? Or it could be a contractual right to exchange assets or liabilities with another entity under conditions that are potentially favorable to the entity. So we're saying you probably have purchased a call option or purchased a put option. Confirm you'd only exercise this if it's actually favorable to you. So can you see the link between your financial accounting and your management accounting and finance? Now you need to be able to pick out in what case will I actually exchange assets or liabilities with another entity under conditions that are potentially favorable to the entity. So the moment you've purchased a call or purchased a put, you're saying I have a right to buy or sell, and you'd only exercise that right if it's actually favorable to your entity. A financial asset is also any asset that is a contract that will or may be settled in the entity's own equity instruments and is a non-derivative from which the entity is or may be obliged to receive a variable number of the entity's own equity instruments, or derivative that will or may be settled other than by exchange of fixed amounts of cash or another financial asset for a fixed number of the entity's own equity instruments. So from this aspect of financial asset, it is important to note that for it to be a financial asset, the contract has to be settled in your own equity instruments as the entity, and then you're obliged to receive a variable number of your own equity instruments, or to settle by exchanging a fixed amount. You're expected to settle other than, which means you're not settling by exchange of a fixed amount for a fixed number of an entity's own equity instruments, but rather you're settling probably fixed amount for a variable number of the entity's own equity instruments. We're going to delve deeper into this when we get to our financial liabilities. So I'd like to refer you to part 11 of IAS32. This is where you're going to find the definition of a financial asset. Okay, so let's get into a few examples. So we need to identify whether the contracts that I'm going to put up are financial assets. Okay, so you have your PPE. Now your PPE and your inventory would not actually be tested for whether they're a financial asset because there's no contract, which means there's no financial instrument. So if there's no financial instrument, there's no need to actually prove whether it's a financial asset, right? But then let's say you have a lease receivable. In this case, you have a right to receive cash, so this would definitely be a financial asset. However, please take note of the fact that it has been scoped out of IFRS 16. So as much as it meets the definition of a financial asset, it has been scoped out. Okay, so with your trade receivables, you have a right to receive cash, and it is within the scope of IFRS 9. And with your shares, we're saying you're holding an equity instrument of another entity. So our example earlier was holding shares of Cassava. So I hope at this moment you're able to identify whether something is a financial instrument as well as whether it is a financial asset. The key thing to take note of is where there is no contract, you do not have a financial instrument, like in the cases of your property, plant and equipment and your inventory. Okay, so with your financial liability, your definition is also in para 11 of IAS32. Financial liability is any liability that is a contractual obligation to deliver cash or another financial asset to another entity. So, for example, when you have trade payables, or you've taken loans or issued bonds, you actually have a contractual obligation to deliver cash, right? And to exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable to the entity. So maybe you've written a call option or written a put option, which means the moment it's favorable to the holder of that call or the put, they will come through and exercise, but it will be unfavorable to you. A financial liability is also a liability that will or may be settled in the entity's own equity instruments and is a non-derivative from which the entity is or may be obliged to deliver a variable number of the entity's own equity instruments, or a derivative that will or may be settled other than by exchange of a fixed amount of cash or another financial asset for a fixed number of the entity's equity instruments. So in this case, it's important to say, are these equity instruments the entities or somebody else's? And is the amount to deliver or exchange fixed or variable? Because from this, you can take note of the fact that for it to be a financial liability, you need to have a variable number of the entity's own equity instruments, or it needs to be settled other than by exchanging a fixed amount of cash for a fixed number of equity instruments. So we're saying that it has to be variable. So let's say you sell an option to deliver 1,000 cassava shares to your friend. So this would be a financial liability because the shares are not your own shares. So you definitely have to go out on the market and purchase them. And so the shares are somebody else's, so it's a financial liability. But if you sell an option to deliver your own shares, also okay, so if you sell an option to deliver your own shares and the total value of, let's say, 10,000 to your friend, there's a financial liability too, because although the shares are yours, their number is variable, because the exact number of shares that you'll actually give out to your friend will depend on the price of the shares at delivery. So you will actually calculate the value that you have to pay as the 10,000 divided by the market price of one share. So you essentially have a liability. And if you sell an option to deliver 100 shares of your own shares to your friend, there's an equity instrument because the shares are your own and the amount is fixed. So this therefore means that it's not a financial liability. Okay, so take note of the fixed amount and fixed number. So let's apply our financial liability definition. Okay, so if you have income received in advance, what is your obligation in that case? In that case is to deliver some sort of good or service. So you don't have a contractual obligation to deliver cash, therefore it fails the definition of a financial liability. And what about a provision for dismantling, right? So in that case, you have a contractual obligation to dismantle, let's say, PPE at the end of its useful life. So in this case, you don't have a contractual obligation to deliver cash or another financial asset. So it therefore also fails the definition of a financial liability. But in the case of a loan, you're saying that you have a right to actually deliver cash to the holders of that loan, so it therefore meets the definition of a financial liability. Okay, so at this point, I hope we understand what a financial liability is. Let's move on to equity. Para 11 also defines equity as an equity instrument. So it says an equity instrument is any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. So your equity instrument is basically your own equity, and it may not include only shares, but maybe any options or warrants or other instruments, right? So it is not always easy to differentiate between your financial liability and your equity. So it is important when you're trying to say, okay, is this a financial liability, to identify whether the critical feature has been made. So the critical features, so para 17 explains this. So for you to say you have financial liabilities, you need to say, do I have a contractual obligation to deliver cash or a financial asset, or alternatively to exchange financial assets or liabilities under potentially unfavorable conditions? So the contractual obligation to deliver cash or a financial asset is generally referred to as the critical feature of a financial liability. So let's look at example 1. You have a loan to be repaid in 5 years' time. Confirm in that case, you actually have an obligation to deliver the cash in the 5 years, so you definitely have a financial liability. But things get a bit complex where we have, let's say, redeemable preference shares with cumulative dividend. From face value, confirm this seems like equity. But then it's important to note that the substance of a financial instrument is more important than its legal form and therefore governs classification. So let's get back to our example of our redeemable preference shares with cumulative dividend. The legal form of the preference shares is that they're shares, right? They're equity, they're an equity instrument. But the substance is that you're saying these shares are redeemable, so at a future date you actually have to pay out cash, as well as the dividend is cumulative, which means that when you redeem, you actually need to then pay out the cash in relation to the dividend. So in this case, your redeemable preference shares, although the legal form is equity, the substance is that your redeemable preference shares are a financial liability, as well as the cumulative dividend, as it has to be paid out. It accrues if it's not paid. I want us to get into compound financial instruments. So sometimes a financial instrument has characteristics of both the liability and equity components. So it's necessary to separate your components into financial assets, financial liabilities, and equity instruments based on the definition of a liability and equity. And take note of the fact that your equity is always a residual. This will be important when you're not trying to calculate the value of your equity. So let me give an example of a compound financial instrument. So maybe you have a convertible bond where an issuer issues a bond to a holder, and the holder has an option to get the bond repaid by some number of ordinary shares of the issuer instead of taking cash. Here there are two components. So you have a financial liability, a loan, because the issuer has ability to settle the loan with the transfer of cash, and an equity instrument, which is the call option written to the holder to deliver some number of ordinary shares. In this case, the issuer needs to classify and present the two elements separately. The loan element is presented as a financial liability, and the call option is presented as an equity instrument. We are saying if the holder is the one that has the conversion option, right? They could say, okay, fine, you know what, I want cash, so you definitely have an obligation to deliver cash. So you need to take note of the loan element and raise it as a financial liability. But it's also important to take note of the coupon payments, right? With the coupon payments, straightforward, you definitely have an obligation to deliver cash for those. And then with the call option, we're saying it has to be presented as an equity instrument. So we're going to get it to an example. So In order to raise capital required to expand, Cookies and Cream issues 1,000 convertible debentures at par value of 500 each on 1 January 2015 to Macaroon. The debentures are convertible at the option of the holder into ordinary shares of $5 each on the basis of 100 ordinary shares for each debenture on 31 December 2018. The debentures are redeemable at par on maturity, and the coupon payments of 8.5% per annum will be made annually on 31 December. So guys, I need you to then identify the different components to this financial instrument. So you have obviously the easiest is the coupon payment. It's one component, and that would be a financial liability because you're saying that you have a contractual obligation to deliver cash in the form of the coupon payments. But then the debenture then also holds the loan component, which is redeemable at maturity at the option of the holder. So that principal amount would also be your financial liability. But the holder also has a call option, and this will have to be recognized as equity, right? Because we're saying that they're getting a fixed amount of financial instruments. I hope this lecture was helpful in actually breaking down your financial assets, your financial liabilities, and your equity. But the key point to take home is say, is it a financial instrument? Do I have a contract there? Once you have that, you can then break it down to your financial asset, financial liability, and your financial equity. Thank you for your time.